perfect day to have you, whether we're talking about Japan, whether we're talking about what's going on in Europe. I kind of want to start with the president's latest assaults on European allies and market reaction that we are seeing. Is the talk actually turning into something that our allies are concerned about?
I think so. It feels very chaotic again. So Bessent is right to refer back to April of last year when there was a panic. I know last night I went to bed in a panic and woke up in one, and it didn't get any better.
Because of Japan?
Well, because of so many things. We thought the president was going to Davos to talk about housing and credit card affordability. Suddenly now it's become about Greenland affordability. How are we going to buy or take it? And how are the European countries going to finance us? Are we going to re-tariff them? And it seems crazy, except that things have a way of happening which people didn't think would happen. So you have to back away and de-risk a bit. Japan, I don't know if that necessarily came out of the blue, but we're now faced with that, where the bond markets become unanchored because there are going to be snap elections and everyone's going to compete for fiscal stimulus. If we're looking at the bond markets and assessing all of these things, it feels that the fiscal austerity, which everyone embraced after the great financial crisis, is out the window. It's now borrow and spend. There seems to be plenty of capital around to finance it, and a backup in yields may not be so bad. So yeah, things are a bit chaotic, and the markets do feel a bit panicked.
So Bob, you know there's chaos, there's chaotic moves, there's de-risking, and then there's de-risking. So is this like a short-term think until we really figure out how much of what the president is saying is just rhetoric or the first negotiating ploy, or something that sticks around longer and impacts the investment landscape longer?
It's hard to know. I would have liked to have heard something at 1 o'clock. Instead, it's sounding like a domestic victory lap, then board Air Force One and head to Davos and deal with a whole international array of problems. And my guess is the administration is going to put everyone on their heels and negotiate the best deal, whether it's Greenland, whether it's Venezuela, whether it's tariffs, whether it's with China, who knows?
Should the president be taking a victory lap based on what you've seen in the past year?
If I'm purely objective and sit here in January and say we're heading into 2026 with some momentum. We closed out the fourth quarter pretty strong. We're expecting somewhere either side of 2.5% for GDP and inflation in the U.S. The U.S. is collecting some tariffs. The effective rate's about 16%, so that's a source of revenue. The markets are at highs, and that momentum looks like it's going to continue. So, yeah, I think you can claim that if you want to.
A chance, though, that the bond market and, perhaps even the equity market are overreacting. The president, for much of last year, there was the taco trade. The idea that what the president said wasn't necessarily what ended up happening. And I think, the so-called Liberation Day tariffs are a perfect example of that.
We're entitled to overreact. I think we've been pretty well behaved for a while. Volatility metrics have been abnormally low. We're allowed to throw our toys out of the pram every so often. I think this is a message from market participants to the administration. We can only go so far, and they've got to figure out where the line is. I think what Bessent forgot to include was, yeah, the market had a fit in April, and then they backed off of a lot of things, and then calm ensued. We need to hear some of the same kinds of things.
We should note the president is still making comments at the press conference. We'll go back to it when he does take questions from the press. You can see it right there on the screen. Also check it out on LiveGo on the Bloomberg terminal. You mentioned the reaction back in April. I believe the technical term the president used was the bond market got a bit yippy. Is the bond market yippy now?
Not yet. if you look at Japan, Japan has a whole host of domestic things to deal with. So that's become unanchored. When I look at the U.S. market, yeah, we backed up a little bit. But you know what? We've got a Fed funds rate at about 3 5/8. The 2 years within touching distance of that. You've got somewhat of a normal steepness to the yield curve from Fed funds to twos to the 10-year and the 30-year. It all feels pretty orderly now, a bit of a pause. So I actually think things feel okay.
Anytime I feel like, Bob, we pull up geopolitics and people are like, well, who holds U.S. treasuries? And we've got a story on the Bloomberg that talks about European countries holding trillions of dollars of U.S. bonds and stocks, some of which sit with public sector funds. And so there's, the speculation that could our allies or even folks like China or something like sell U.S. debt. Is there really any alternative into U.S. debt realistically?
No, there is not. And we did this about a year ago. We went through this in March, April, May. We spent a lot of time talking to our clients, particularly our non-U.S. clients. They looked at everything and came back to, when you look at the U.S. debt markets, which includes governments, but it's corporates, it's securitized, no other markets have the depth and the breadth. They have confidence in the country. They're not willing to abandon it. They see the presidency as two-year terms when you throw in the midterm elections. So they're willing to ride through it. I don't think there will be wholesale selling of U.S. Treasury debt.
So you're referring to the Danish pension fund academic or pension to exit U.S. Treasuries.
And that's a small, but I just, in general, like I think about, we've talked about it in terms of China or just any, that this is a great lever that foreign investors or foreign governments could pull against the U.S. But the reality is they're not likely to, because there kind of is no alternative.
We had a lot of very large non-U.S. clients look at alternatives and line up plans. If we were to sell this is where we would go. And they paused putting more money into U.S. bonds, but they didn't take any out. And by the end of the summer, they were putting money back in again.
We're speaking with Bob Michele, Chief Investment Officer and Head of the Global Fixed Income Currency and Commodities Group for JPMorgan Asset Management. The president's still speaking at the White House. We do expect him to take questions too in just a little while. Back to this pension, because Anders Schelde cited, this is the fund's Chief Investment Officer, cited Trump's talk of taking over Greenland, concerns about fiscal discipline and a weaker dollar for reasons for the decision. You don't buy the fiscal discipline and the weaker dollar part of this. You think this is just political?
Where is there fiscal discipline now? It's hard to find it. Like, go to the old stalwarts. Germany, not there. Look at what Japan could and couldn't do. That seems to have been abandoned now. The U.S., for sure, we'll see who the next Fed chair is, but it sure ain't going to be the next Paul Volcker walking in. So I think fiscal discipline is a thing of the past, and there is a feeling that deficits can be financed, and Japan is kind of telling us you can get to 300% and life's still good.
So when do we pay the piper on this global lack of fiscal discipline? I think about Andrew Ross Sorkin, who was just on to talk about his book 1929, and we talked about crises in particular or in general, and that leverage and debt, right? These are the things that get us into trouble, whether we're an individual, a company, or a country, or Ken. So is that potentially the next crisis, just the lack of fiscal discipline globally, or do we just kind of continue to go along here?
So I read 1929. It was very engrossing. I don't see the problems that existed then here today. I don't see the rampant leverage throughout the system, which is becoming problematic. It can't be served as. It's being written down.
Even on a government or sovereign level.
Yeah, it's not happening at the government or sovereign level. And,
okay.
And that new tool called QE allows that to perpetuate.
Right. Well, that's the point. Like, I think about years ago, I remember not doing an interview, a business news interview or markets interview, without talking up about the U.S. government debt. And then it went away. And now we are back again. So, I think we kind of continue to try and find out, when is it really a problem. Certainly as rates go higher, it becomes more expensive to service, certainly here in the U.S. But I'm just wondering, like, when...
I think when it gets thrown away, I started in the business in 81. I worked through the twin deficits. I was taught the U.S. will never be allowed to finance itself below 10% again. And we promptly dropped from 16% to 0.3%. And in the Clinton era, suddenly, the deficit was gone. We look at where the money is being spent, and we may not always agree where it's being spent, but it does create some productivity. We talk to all the municipalities that are accessing the various programs they can. They're actually going in, taking capital, they're hiring people, they're consuming resources, and they're investing in their townships or their states or their cities or whatever it can be. Ultimately, that generates activity that gets taxed, and I think that's what we saw in the late 80s into the early 90s.
Last question, I'm going to make you push ahead to our conversation with Robert Kaplan, Vice Chair at Goldman, and we're going to be hearing from him in just a few minutes on the Fed. Polymarket has Kevin Warsh as the favorite for the nomination. In fact, Rick Rieder is now number 2, which is interesting to see. Who has the bond market priced in as the next Fed chair?
I don't think the bond market has a great idea. Rieder's number 2 for me. I've known him for close to 40 years. I think he'd be an excellent Fed chair. I think he'd be somebody very different. Let's get a true bond markets practitioner in there who's had to live with the aftermath of Fed decisions. So I'm certainly a supporter of his, but he's number 2 behind Bessent is still my number 1. Oh. I think the president is still stalling and trying to negotiate with Bessent. I don't see Warsh too hawkish. Hassett's got to be removed because of the DOJ. And Waller, I don't know that the administration feels they can control Waller. Rick is the, shining knight that comes in out of left field. Smart guy will do the right thing, but I still think it's Bessent number 1.
Was not expecting to hear that.
So right thing, whether it's Bessent or Rieder or whomever, will be independent, or that depends?
I've never fully believed that they're independent because they're political appointees. So they get appointed for their core views. I believe when they're in office that they always try to do the best thing. But some believe that fiscal austerity is the best policy, and other believes that a lower cost of funding and economic activity and monetarism will help stimulate the economy.